With high property prices and zooming interest rates, buying a dream home had become a distant dream for many last year. But the tide seems to have turned. However, with interest rates softening, the gap between fixed home loan rates and the floating rates has widened. And experts believe it is time to make the most of the floating interest rate option. Vidhi Godiawala now joins us to tell us more.
Well, Vivek, in a fixed loan, one knows their EMI vis-a-vis a floating rate loan, where your EMI changes according to interest rate fluctuations. However, fixed rate loans need not necessarily remain fixed for the entire tenure. They come with two clauses which customers are not well versed with. These clauses are a resetting clause and money market clause, and the events on which lenders can change rates is loosely defined, making it complex for customers' understanding.
Sometimes you have a loan called a fixed rate loan, where it is stated that at the end of every 2 years or 3 years or 5 years the rate will be reset. Even that's called a fixed rate loan. It's actually fixed rate for 2 years, 3 years, 5 years and variable thereafter or floating thereafter. Most fixed rate loan contracts also have a very, what shall you say, an omnibus kind of a clause which gives unfettered right to the lender in the event of any major changes in money markets or in the change of policy within the lender's own organization, etc. The bank reserves, the lender reserves the right to change the rates.
A 200 to 250 basis point difference has always prevailed between fixed and floating loans. However, with interest rates zooming up in the last 6 months, we did see some kind of tightening in the fixed and floating loans. But now with RBI's measures in the last 3 months, rates were heading southwards. And while fixed loan rates for new customers remained the same, and floating loans did see a cut resulting in a wide gap between the rates.
When the rates have dropped, we have not seen the rates of genuine fixed rate loans drop. But we've seen floating rates drop, so the gap has increased.
From a lender's perspective, there is a gap obviously between a fixed rate and the floating rate, and it has always been for so many years. It has changed even a little more now because the economic scenario has moved so erratically over the last 6 months, 9 months time. So the premium over a floating rate of a fixed rate may be about 50 to 100 basis points higher today as it was before.
The gap between interest rates charged by banks has widened to as high as 5% in some cases. ICICI Bank, for example, offers fixed loans at 16% and floating at 11%. Axis and HDFC are fixed at 14% and floating at 10%. Kotak and IDBI do not provide fixed home loans to customers. SBI's fixed home loan above 30 lakhs is 12.25% and the floating loan is at 10.25%.
Very few banks that are actually giving genuine fixed rate loans, and none of them would be cheaper than 13.5% or 14%. And today typically even a non-subsidized floating rate loan, which means more than 20 lakhs, not part of the stimulus package that's been announced, would be available between 11 and 11.5%. So there is a vast difference between what you pay for a genuine fixed rate loan versus what you pay for a floating rate loan.
Floating loans also offer other advantages. Suppose your income increases and you wish to change your EMI by increasing it and shortening the tenure, you can avail this facility in floating loans without any charge. Whereas in a fixed contracted rate, every change witnessed will be accompanied with a contracted cost.
If you have a floating rate, inbuilt into the floating rate scheme normally is a allowable amount of prepayment. So say the different banks which offer different schemes, an X amount if you can prepay out of your own money, obviously you're not borrowing for that, then that attracts no charge. Whereas the nature of a fixed loan transaction, because it is fixed, anything that you do in terms of disturbance of the cash flow will attract a charge, because you have the flexibility here of being able to do a part prepayment which is allowed in a floating rate scheme as part of the bank scheme lending. Then there is no charge. So differentially a guy would pay significantly lesser if he does some structured prepayments in a floating rate scheme as compared to a fixed rate scheme.
If one looks at a home loan tenure which usually is 15 to 20 years, and historically if one compares fixed to floating loans, in floating loans one catches the higher and lower ends of the interest rate cycles, and if averaged out it is much better than fixed loans, unless one is lucky to catch the interest rate cycle at its lowest.